Now, the Bank of Japan is concerned about the continued weakness in the yen. As you can see, the dollar yen in Japan around the end of September. You can see that huge candle here as the Bank of Japan intervened. Now, history is against currency intervention alone being successful in, say, moving the dollar yen lower. The most famous recent example, of course, was the Swiss National Bank with the Euro-Swiss pair, which they tried to keep peg at 1.20, but ultimately failed despite enormous efforts early in January 2015. So the Bank of Japan is going to be wary about trying to send the dollar yen lower as long as US interest rates are expected to keep rising and Japan is maintaining its ultra-low monetary policy. That keeps a dollar yen upside bias. Also notice the seasonals are also against dollar yen falls, that over the last period from 16th of October to 8th of December, over the last 15 years, the dollar yen has gained a total of 10 times and only fallen 5 times with an average return of 2.57%. So does this mean that the dollar yen will continue to track higher despite any actions from the BoJ? So canny traders will see that both history and seasonals are lining up against the chances of success for the BoJ. So any impact of intervention could be short-lived, as we see that short-lived impact on the end of September the 22nd. So the major trade risk here, of course, is that the US pivot and the Bank of Japan change their policy stance, so they start hiking interest rates, and that would likely send the dollar yen lower. Remember, HYCM clients can access the SeasonX product in order to analyze over 25,000 different currency pairs, indices, commodities, as well as individual stocks. So please do contact your account manager for a free trial to get started right away.
Some holiday-related
certain products and services mentioned herein may or may not be available to all clients, depending on which HYCM Capital Markets Group entity their trading account adheres to.